When you need to borrow money, whether it's for a big purchase, paying off debt, or making ends meet, you've got choices. Two of the most common are using a credit card or taking out a personal loan. But which one makes more sense for you? That's what we're going to explore today. Section 1. Setting the stage, let's start with a quick overview. Both credit cards and personal loans allow you to borrow money. But the way they're structured and how they work in practice are quite different. The right choice depends on your goals, how much you need to borrow, how long you plan to repay, and how disciplined you are about payments. Section 2. Biggest difference between a personal loan and a credit card, one of the key differences. A personal loan gives you a lump sum of money at the start, and then you repay over a fixed schedule. A credit card, by contrast, is a revolving line of credit. You borrow as you go, pay it back, borrow again, as long as you stay within your limit. Here are a few important subpoints. With a personal loan, the interest rate is often fixed and the monthly payment is fixed, and you know exactly when you'll finish repaying. With a credit card, the interest rate is often variable. The payment may vary, especially if you carry a balance, and there's no fixed end date unless you change strategy. Because a personal loan is not a revolving product, you're less likely to keep borrowing more once you've taken it. That limits the chance of spiraling into more debt. Credit cards give flexibility. You borrow what you need when you need it, but that flexibility comes with risk if you're not careful. Section 3. How personal loans work? Let's dig deeper into personal loans. When you apply, you're usually borrowing a set amount, say $10,000, with a fixed annual percentage rate, APR, and a fixed term, say 60 months. For example, someone with excellent credit might borrow $10,000 with a 5.99% APR and a 5-year term, paying about $193 per month. Because you know exactly what you owe when you'll pay it off, and your rate won't change. In most cases, it offers predictability. That can help you stick to a budget and reduce uncertainty. One financial coach pointed out that because the loan doesn't let you borrow again and again, unlike a credit card, it may help prevent you from accumulating even more debt. Section 4. When you should use a personal loan. So when does a personal loan make sense? According to the article, if you need to borrow a specific amount and know you'll need more time to pay it off. If you want a fixed repayment schedule, so you know when you'll be done. If you're concerned that using a credit card might tempt you to spend more, since credit cards are open-ended. In other words, if you have a defined goal, a set budget, and you want structure and clarity, a personal loan may be your better bet. Section 5. When you should use a credit card now, let's flip to credit cards. When might one of those be the smarter option? The article notes, if you're making smaller purchases and can pay them off quickly, then the convenience and flexibility of a card can shine. If your card offers rewards, cashback, travel points, and you consistently pay your balance in full every month, you might come out ahead. If you have an introductory offer, for example, 0% APR on purchases or balance transfers for 12 to 18 months, you might borrow without interest for a while, then pay it off before the rate kicks in. But the article also warns, if you carry a balance, your variable rate can be high. Because the line is revolving and you can keep using it, it's easy to keep accumulating new debt. Section 6. Comparing key features side by side, let's compare some features of both, so you can see them more clearly. Feature personal loan credit card borrowing structure lump sum. Fixed term revolving line of credit interest rate, typically fixed, usually variable monthly payment fixed. Unless you change terms, varies depending on balance and rate end date, yes. You know when you finish no fixed end date unless you pay it off, risk of overspending lower because no new credit after you borrow higher. Because you can keep charging up new debt, rewards / benefits, usually fewer rewards tied to the loan itself many. Cards offer rewards, protections, perks best for borrowing known amount, long-term payoff, purchases you can pay off quickly. Flexible borrowing. This table is derived from the differences pointed out in the article. Section 7. Things to watch out for whether you choose a personal loan or a credit card. There are pitfalls. The article underscores this. Borrowing more than you need can lead to long-term repayments and cost you more in interest. If you stop making payments, whichever product you've picked, it can harm your credit score. Even with the best terms, you should leave wiggle room in your budget. Life happens. Unexpected expenses arrive. So plan for the worst. Section 8. How to decide which is right for you. Here's a recommended decision path based on the article's guidance. Ask yourself how much you need to borrow. If it's a large fixed amount that you will repay over several years, a personal loan may make sense. Consider how long you'll need to repay. If you want structure and certainty, go for the loan. If you expect to pay off quickly or borrow sporadically, maybe a card. Look at your discipline with credit. If you're confident you'll pay off your card in full each month and avoid carrying a balance, a rewards card can provide upside. If you worry you'll keep using it and racking up more debt, a loan may give you more control. Check interest rates and fees. Compare what interest you'd pay on a personal loan versus what your card offers or what it would after any intro period. Think about your purpose. Is this debt for a one-time thing, home improvement, debt consolidation, or for ongoing purchases? Budget realistically. Make sure your monthly payment fits your budget, with room for surprises. Read the fine print, whether loan or card. Check for hidden fees, variable versus fixed rate changes. What happens if you miss payments? Section 9. Example scenarios. Let's illustrate. Suppose you want to consolidate $10,000 in credit card debt, and you have good credit. You might get a personal loan at 5.99% APR for 5 years, paying about $193 per month. You know exactly when you'll be done. That's appealing. Alternatively, suppose you want to buy a new appliance for $2,000 and plan to pay it off in 12 months. If you can find a credit card with 0% introductory APR on purchases for 12 months, the card might make sense. You get flexibility and possibly rewards. But you must commit to paying it off before the 0% period ends. Section 10. Bottom line. Here's the bottom line, as the article summarizes it. Whether you lean toward a personal loan or a credit card, remember, you can still make a poor choice. You can borrow more than you need. You can get trapped by high interest. You can miss payments. The most important thing is this. Think about how much you need to borrow. Think about how long you need to repay. Think about how much you can afford each month. Then pick the product that best matches those answers. If you do that, and you leave room in your budget for the unexpected, you'll be in a much better position to borrow responsibly and make progress toward your financial goals. Conclusion. In the end, borrowing isn't inherently bad. It's the way you borrow and the way you manage that debt that determines whether it helps you or hurts you. If you use either a personal loan or a credit card with discipline, clarity, and an eye toward your budget, you'll put yourself in a stronger place. If you borrow without plan or lose track of payments, problems can follow. So next time you're faced with a borrowing decision, pause and ask, do I need a fixed lump sum with a fixed schedule? Or do I want flexibility and possible rewards? And can I handle the risk? Choose accordingly. Thank you for listening. If you found this helpful, consider revisiting the key differences and making a choice that aligns with your situation. Until next time, borrow smart, pay responsibly, and may your financial path be a good one.